All right, hi everyone. Welcome to today's webinar brought to you by IC Markets Global, where the topic is going to be on preparing for 2024. Right, before we start, I just want to make sure you guys can see my screen. You should be seeing the first page of my presentation slides. As just want to make sure the audio is good as well. Can you guys hear me and see my screen as well? Do take note of I have the Q&A and the chat windows are up and running as well, so I'll be monitoring this as well. All right, thank you, Zoran. All right, great. And do not hesitate to drop any questions or requests that you may have along the webinar. All right, okay, so let's just kick things off. All right, okay, as usual, please take note of the disclaimer. This is marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for the transactions in financial instruments. Also, take note of the risk warning that comes with trading Forex and CFDs, as they carry a high level of risk to your capital, and you should only trade with money you can afford to lose. All right. My name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership by IC Markets Global and Everest Fortune Group, where we have been the finalists for the best FX and equity research for the following years, 2019, 2020, and 2021. All right, that's a simple agenda for today. Topic is preparing for 2024. What are the key trends to look out for coming to the end of the year, and also what to look out for as we move into the new year? And what are the current key bullish trends, and of course what are the current key bearish trends, and then we'll analyze some of the major currency pairs, commodities, and indices as well to watch out to take note of what are the key technical levels to watch out for. All right, okay. Right, so what are the key trends to look out for? As we all know, for most parts of 2022, 2023, it was all about inflation, right? Rising inflation in 2022, and for coming to 2023, we have seen inflation peaked across various metrics. When you look at inflation data in the US, we have the CPI data, which is Consumer Price Index. We have the PPI data, which is Producer Price Index. This measures the level of inflation in the wholesale sector or wholesale inflation. And we have the PCE, which is the Personal Consumption Expenditure Index. This is the Federal Reserve's preferred measure of inflation. So although there's few various metrics or data points we can look at, it's important to take a view of all these three major inflation data points, especially with regards to the PCE, because this is the metric that the Fed keeps a very close eye on. All right, and of course, so what about inflation? So if inflation continues to fall steadily, that means, of course, inflationary pressures are receding, and that means central banks around the world, especially the Fed, have pretty much come to the stage where they have battled and tamed inflation, right? Although inflation is still a level away, a while away from their 2% target, but to see it retreating quite sharply, especially over the last few months, gives central banks like the Federal Reserve fairly strong confidence that the higher interest rates are working, and there's no reason for them to continue raising rates. So as you see, central banks around the world have maintained or paused their interest rates over the last few months. And if we had looked at the last meeting, the last FOMC meeting on December 13, we saw the Federal Reserve put out a very, but put out a dovish statement, as well as during the press conference, Chairman Jerome Powell was equally dovish as well. So that triggered a huge dollar sell-off. We saw the value of the US dollar fall. That, of course, means dollar index is going to fall. We also saw US Treasury bond yields fall quite sharply as well following this meeting, right? So because of this perceived pivot by the Fed, markets have sort of front run the rate cuts. So we are seeing bond yields fall, we are seeing the value of the US dollar fall, right? Another key figure to look out for would be employment figures. Of course, over 2022, over the last 2 years now, we can say employment figures have been robust, right? When we look at the NFPs, monthly gains in the NFPs, the unemployment rate, and as well as the unemployment claims. Generally, when you combine all these three data points, they have been fairly robust, which was what gave the Federal Reserve the confidence to continue rising interest rates very aggressively in 2022. because if we had seen the labor market break or we saw the labor market start to crack, I'm pretty sure the Fed would not have raised interest rates so aggressively, and they would have come to a pause much sooner. So do take note of this. If we see employment figures starting to weaken and the US labor market starting to crack, then that should signal that the Fed is already going to start cutting rates pretty soon. All right, next, of course, we have to look at the economic growth of the US as well, right? You have to see how GDP is growing every quarter. You also have to look at the monthly PMIs. Again, combined with employment figures, will give the Fed further evidence of whether to um, maintain rates or to cut rates, right? Because if we do see the economy chugging along quite nicely, and we see employment figures being relatively stable, we don't see a spike in the unemployment rate, we don't see a spike in unemployment claims, that may delay the Fed to officially start cutting rates, right? So do take note that how employment, inflation, and economic growth could determine the path of how quickly the Fed will start cutting rates, or whether the Fed is just going to maintain rates. And the next key trend, of course, the last key trend to watch out for would be a pivot by central banks. As I mentioned earlier, most of the central banks have paused, right? They've maintained rates at elevated levels, and they've not signaled any further hikes in interest rates. They've all pretty much adopted a wait and see approach, and they'd like to see further incoming data on inflation, employment, and economic growth before deciding whether are they going to cut rates or are they going to just maintain rates, right? Okay. So let's look at inflation. We're going to look at all these three things from the perspective of the US. Why is that? Because we all know the most influential central bank in the world is the Federal Reserve. So whenever they make a move, whether it's a interest rate hike or a cut, it is very it's felt worldwide, right? It has a major impact on global financial markets. So we'll just look at all these data points from the perspective of the US. All right, okay. With that, okay, so here I've got the charts for CPI, Consumer Price Index. On my left here, we have the chart for headline CPI, and on the right, I have the chart for the core CPI, which is less food and energy. So in general, we can see the headline CPI peaked at 9.1% in June of last year, and it has retreated quite sharply over the last 18 months or so. And with the latest reading coming in at 3.1% year over year, this gives the Fed fairly strong confidence that inflation is going to continue to slide lower, especially with the core following suit as well. As you can see, the core peaked a bit later, a couple of months later in September of 2022 at 6.7%, and then it started to retreat, right? So you can see both the headline and the core readings slow down quite drastically over the last few months. And as you can see clearly, 3.1% for the headline reading and 4% for the core reading are both quite far away from the Fed's target of 2%, right? 2% inflation at an annualized basis. So although this is still, these lab figures are still quite far from their target of 2%, the Federal Reserve and Chairman Powell seem quite confident of putting out a dovish statement and conducting a relatively dovish press conference as well, right? Okay, next we are going to look at PCE. This is personal consumption expenditures. Like I said at the start, this is one of the key inflation metrics watched very closely by the Fed. It is their preferred gauge of inflation, right? So similarly, this peaked in June as well. Headline PCE peaked in June of last year, 2022, at 7.1%, and the current reading is at 2.6%. And the core PCE reading, it took a while, but it peaked earlier in February of 2022 at 5.6%. It remained relatively elevated for most parts of 2022, and it was only 2023 where we saw the core PCE reading start to fall as well. So as I said, the combination of falling headline and core CPI plus falling headline PCE and core PCE data points have given the Fed that confidence to issue that dovish press statement. Right. Similarly, you can see that the 2.6% reading for the headline PCE and 3.2% for the core are quite well away from the Fed's target of 2%. Right, but of course, should inflation continue to slide lower, especially with December's numbers coming up next year in January, then of course, right, we could see um, the value of the US dollar continue to slide lower, and of course, Treasury bond yields falling lower as well. All right, so this is producer price index. This measures inflation in the wholesale sector. So you can see because of the manufacturing, because the higher interest rates had a more impact on manufacturing, and also we saw that shift from consumer spending from manufactured goods into services as well, right? So as economies reopened, everyone went on revenge traveling and so on and so forth. They started to buy perhaps less stuff, and they were spending more on services. So hence we saw PPI pull back quite drastically, right? It peaked in March for both the headline and core reading, and with now you can see they've decelerated quite sharply over the last 18 months. All right, next up we have US unemployment. So here we have the non-farm payrolls, the total non-farm payroll number on the left, and of course with the unemployment rate on the right. So similarly, oh, hang on, just for this slight error on the, just give me a minute while I just, this should not be here. And this is fine. Yeah, this is right. Okay, sorry about that. Okay. Okay, so on the left, we are looking at the total number of employed people in the US. So this is a total non-farm payroll. So as of November, I think there was about 154 million Americans employed. So as you can see, after the huge plunge, of course, due to the COVID lockdowns, we saw the economy reopen, and thus jobs slowly being added back. And of course, we surpassed the pre-pandemic high back. I think it was at the end of 2022, I believe. That's why we surpassed the previous peak, and then we've grown quite steadily as well. So one thing to take note of non-farm, we also look at, of course, the monthly changes, right? So if jobs are being continuing to be added regularly on a monthly basis, beating expectation, that signals a robust US labor market. Similarly, unemployment rate has sort of range between 3.4%. The lower bound here is about 3.4%, and the higher bound is about 3.9. So you can see that it's been relatively stable. We did have that slight increase over the last few months, but November's reading turned down again. So as of now, employment in the US is still fairly strong. So of course, that gives the Federal Reserve the impetus to at least maintain rates to ensure that inflation continues to slide lower, right? But of course, if we do see the US labor market beginning to crack, right, we see unemployment starting to spike quite quickly over the next couple of months, and we see the total non-farm payrolls stagnating, and perhaps even jobs being lost, then of course the Fed would be quite quick to pivot and start cutting rates. Another metric to look out for, okay, of course, with non-farm payrolls and unemployment rate, these data points are released on a monthly basis. We can argue that they're backward looking as well, because it just tells us what has happened in the past and not what is currently going on. Sorry. A good way to get a sense of how the US labor market is doing is by looking at unemployment claims. So now this data point is released on a weekly basis. So what this tells us is the number of Americans who are filing for unemployment benefits every week. So if the case like this, where you see the blue bars, which is the actual result, and the orange bar is the estimate. So when you see unemployment claims trending higher, it sort of signals that the job market is, labor market is perhaps beginning to show signs of distress. And if you see that unemployment claims trend lower, that means less people are filing for unemployment benefits every week, and also that figure is coming in lower than the estimate, then that signals a stronger labor market. So you can see at the start of 2023, at least the first half, unemployment claims started to rise quite sharply. So perhaps at that point of time, people were wondering, is the US labor market starting to crack? But after that, it actually stabilized, and we saw unemployment claims start to trend lower as well. So do take note, in general, it has been trending lower for sorry, at least since the second half of 2023, which tells us that the US labor market is still in relatively good shape. So, of course, with a strong labor market, consumer spending should be relatively stable as well. And of course, that means the Fed is more likely to keep rates on hold, and they may not be cutting rates so quickly. All right, next, looking at GDP growth, we can see, of course, after during the COVID lockdowns in Q1 and Q2. Oh, sorry, not in Q1 and Q2, so not COVID lockdowns. In 2022, the US went through a technical recession. So what's a technical recession? Basically, that's 2 consecutive quarters of negative growth, which is what we saw at the start in the first half of January, -2% and -0.6%. But the economy quickly rebounded after that. So all the fears of a recession back then were were put at ease as the US economy rebounded relatively strongly, led by the services sector, right? As I mentioned, there's a big shift from the manufacturing and services sector, and the services sector basically propelled overall economic activity in the US in the second half of 2022, and of course for most parts of 2023. So if you see here, just a quick brief of how US GDP has been growing. So in the third quarter of 2023, it grew 4.9%, which was slightly below the estimate of 5.2%. But regardless, it was still one of the strongest growth rates since the last quarter of 2021. Consumer spending also rose as well, but less than anticipated. And we can see that this was due to the slowdown in services spending. Exports and imports are both increasing, but of course less than initially anticipated. So of course, this is just this of GDP data. Of course, is backward looking. It doesn't tell us anything about the future, but we can see that the US economy grew pretty strongly in the third quarter of 2023. All right, next up is PMIs. Right, PMIs are Purchasing Managers Index, and what we're looking here is the composite PMI, which is a blend of the manufacturing PMI and the services sector PMI. So as you can see, in the second half of 2022, the composite PMI. Okay, just for those who may not be familiar with PMI data, any reading above 50, which is here, you see the threshold of 50, any reading above 50 signals expansion for both the manufacturing and services sector, and any reading under 50 is signaling contraction for that sector. So of course, we can see with the pandemic lockdowns, PMI activity, of course, crashed and falling as low as like 27 or 26 before rebounding quite sharply, relatively sharply, as economies reopen. Right. So similarly, in the second half of 2022, the composite PMIs fell into contraction again, and then but it has rebounded quite strongly and has been expanding relatively stable over the last. The growth rate hasn't been very sharp as we saw during this period in the latter half of 2022, but overall for most parts of 2023, the US economy has been chugging along quite well. Okay, so again, right, if the economy starts to tank, then naturally the Fed is also going to pivot quite quickly. So that's not happening as what we saw for Q3 data and also for the latest PMI data as well. Right, so we can see the US PMI rising to 51 in December of 2023, right? So third straight month of growth, the fastest pace in 5 months. Sharpest increase in new orders. This is important because new orders signal future demand. So if you see new orders increasing every month, that means future demand is going up. So we can expect the economic activity or the economic growth to continue. And once again, this is the services sector that's pulling up overall economic activity. And you can also see employment growing at the quickest rate in 3 months. So the economy is strong, employment is good, labor market is strong, inflation is receding quite sharply. So Fed is probably likely to keep rates on hold, even though they've signaled 3 deep rate cuts for 2024. All right, so just a quick take a quick look at where the interest rates for the major central banks lie. Of course, with the Fed, it is between 5.25 and 5.5%. If I'm not mistaken, they've paused for the second consecutive meeting in a row, or is it the third? I'm not too sure. Similarly, for the euro, they've paused for the first time as well, keeping their rate at their main refinancing rate at 4.5%. Similarly, for Bank of England, they've kept it steady at 5.5%, with the Bank of Japan being the only outlier, keeping rates at negative 0.1% since 2016. Although inflation was a global phenomena, apparently Japan was one of the few countries that did not experience it, at least when you look at their CPI readings for both the headline and core CPI readings as well. Right. Okay. So because of this ultra dovish monetary policy stance by the Bank of Japan, earlier this year in 2023, we saw the dollar yen rise quite sharply as well. Okay. All right. Key bullish trends. What are the key bullish trends? Of course, we saw equity markets jump or rebound very strongly, especially after the Fed pivot, or the perceived Fed pivot in December's FOMC meeting. We saw S&P 500 rebounding strongly, coming close to its all-time high, while the Nasdaq 100 has surpassed its previous all-time high quite recently. We also saw major FX pairs like the euro, the pound, the Aussie, and Kiwi rise sharply. Of course, if the US dollar is selling off, and of course, currency pairs such as the euro, pound, and Aussie and Kiwi are definitely going to be rising strongly. Gold also has been supported by a falling dollar, and crude oil has seen a relatively decent rebound over the last few weeks as well, due to a combination of production cuts led by Saudi Arabia, OPEC Plus, and also by the recent drone attacks in the Red Sea that occurred last week as well. Okay, so key bearish trends that are currently ongoing, of course, is the US dollar. We've seen that the sell-off accelerate, especially following the FOMC meeting. We also saw US Treasury bond yields fall sharply, such as the 2-year and the 10-year. And of course, major FX pairs such as the dollar yen, dollar franc, and dollar cat have all dropped as well. Okay, now we're going to head on over to TradingView and look at where the key technical levels are for some of the currency pairs and indices that we have mentioned earlier. All right, so let's dive into TradingView. Right, okay, so here I am on the chart for the dollar index. I'm on the daily time frame. So as we are looking at trying to capture the current trend and trying to see what we can expect for 2024, we're going to do the analysis on the daily time frame. Right, so that gives us a very nice overarching view of how this instrument is traded for 2023 and what can we expect for 2024. Right, so just a quick recap, a walk down memory lane, perhaps, as you can see here in 2022. Right, March was when the Fed first raised their interest rates, and from there you can see from about 98, the value of 98 dollar index went as high as 115, and then it sort of hit a brick wall here, consolidated, went sideways. You can argue it ranged between 110, 113 before crashing lower. So why did it fall very sharply in the last quarter of 2022? Well, primarily this was led by an intervention measure by the Bank of Japan. So if we look at the dollar yen during this period, we saw the dollar yen rise exponentially, right, from March onwards, going from 122 to as high as 152 basically. So during this period, the yen was getting devalued very sharply versus the dollar, and hence dollar yen was rising very quickly, of course led by the Fed's aggressive rate hike. Now a lower yen is good for Japanese exporters, but it's not good for Japanese importers, right? So because of inflation, the fear of inflation seeping into Japan as well, the Bank of Japan intervened in the open market. They carried out intervention measures. So that means they were selling their foreign treasury holdings. Japan is probably one of the biggest, if not the biggest, the second biggest holder of US Treasuries and the US dollar. So they sold their foreign treasury reserves and use the proceeds from that sale to buy back the Japanese yen in the open market. So when they were buying back, or when they were selling the US dollar and buying the Japanese yen in the open market, of course that's going to cause the dollar yen to fall sharply. Right, so you can see from 148 all the way down to as low as 127 by mid-January, right? And if we look at dollar index over the same period, you can see the same price structure as well. Right, so because of this intervention measure, we saw the US dollar sell off sharply during this period. We saw dollar yen come crashing down as well, of course, and that would mean currency pairs like the euro, as you can see here from September, October onwards, had a very strong rebound as well. It is suspected that the intervention measures ended at the end of January, and that's when natural market forces came back into play again. And then you could see the US dollar could range sideways between 100 and roughly 105 for most parts of 2033 for this year, right? Basically ranging. And then, of course, from July onwards, we saw the dollar index accelerate, partly due to hawkish statements and hawkish press conference by Chairman Jerome Powell, as well as his fellow FOMC members, right? So they were basically jawboning the value of the dollar index higher. All right. So with that, and of course we then in the second half or the last quarter of 2023, we saw inflation really starting to pull back in the US, and because of that, markets were pricing in a potential pause or potential pivot by the Fed, and that is why you can see the dollar index start to sell off quite sharply over this period. We also saw bond yields drop drastically during this period as well. And of course, with the FOMC meeting that took place on 13th of December, here my cursor's on 13th of December, you can see this huge daily candle here, this huge red candle here. That's when the sell-off re-accelerated again, right? So since 2nd of November, we can see that dollar index has been in a strong bearish trend. Of course, there's going to be retracements to the upside along the way, but generally you can see that this descending trend line has been respected, and it is making a series of lower highs and lower lows. So that's clearly telling us the dollar index is in a strong bearish trend. We can also see price has broken through the Ichimoku cloud. All right, just a quick review of what the Ichimoku cloud is. It is a trend indicator, right? So when the cloud is green and price is trading above the cloud, it is indicating a very strong bullish trend. Conversely, if price breaks under and starts to trade and the cloud turns red and price is trading under the red Ichimoku cloud, it is indicating a very strong bearish trend, which is what we saw in 2022 and 2023, right? This is just a quick recap for those who may not be familiar with the Ichimoku cloud indicator, right? So you can see throughout 2022, for the first 3 quarters, price was trading above the bullish Ichimoku cloud. The cloud is green. Price, of course, is going to pull back along the way. Nothing goes up in a straight line, but you can see a bullish Ichimoku cloud usually offers support as well. So you can use it as a technical indicator. Of course, it is a technical indicator, and it also can be used to identify potential support zones. So like you can see here, where's my, yeah. So this was, right? This was as the dollar index pulled back in June, the cloud offered support before bouncing high again. Similarly, in August as well of 2022, price came into the cloud, it found support before rebounding and to climb higher. Right. So the good thing about the cloud is it also helps us to identify potential support zones for that particular current instrument. So this can be applied for any instrument, right? It doesn't matter if you're trading dollar index, a commodity, or even the indices or individual stock. The Ichimoku cloud, a bullish Ichimoku cloud offers strong or identifies potential strong support zones, And similarly, when we see price break through bullish Ichimoku cloud like this, it typically signals the end of the bullish trend and is telling us that it's very likely now this instrument is going to begin a very bearish downturn, right? So this is what we see. So that's what the cloud tells us as well. So when price comes crashing through the cloud, you see this time the cloud did not offer any support. We can argue it offered a support for day and a half before finally breaking through. So when you see price action such as this, breaking price action where the instrument, or in this case the dollar index, breaks through, breaks under the bullish Ichimoku cloud, this signals the end of the bullish trend and this reversal of at the start of a new bearish trend, which is what we saw. So pretty much from start of November onwards, all the way down to Feb, we saw the dollar index in a strong bearish trend. And then after that, we saw it consolidate, as I mentioned, as the intervention measures ended. We saw dollar index range approximately between 100 and 105 for most parts before breaking lower in July here, and then bouncing off. So this level here at 100 is a very significant support level as well. 100 being a very round figure, and also we can see in the past here it acted as a pretty decent overlap support as well, roughly around this area, right? We can see this zone here, right? This zone here, price ran into resistance here in March of 2022 a few times before finally breaking higher. And once it broke higher, it found support on 14th April and again on 21st April, creating this overlap support zone here, which is where price once again found support back in middle of July, right? So you can see how when we take top-down approach and we use a higher time frame such as daily time frame or perhaps even a weekly time frame, you are able to spot major or significant support zones and resistance zones, right? And then as you can see, price crashing down, right? Because this is now, we have identified this as a major support zone. As price came down here, if you were shorting the dollar index, right? This is an area or a zone where you would have been looking to take profit here, right? Or close out your shorts. At least you should be starting to book profits around this level at 100, right? Okay, then when so this was sort of like range bound trading here. And you can see, right, you can argue relative, oops, right, roughly not the best is not the best range, right? Not exact, but you can see, you can sort of recognize the range bound trading here that took place since end of Jan till July. So for pretty much, it was a sideways trade for the dollar index. And then of course, then we had the acceleration here in the third quarter, right? Similarly here, you can see that this is, you can see price making a pretty significant swing high resistance here, price finding support here. So this is also was identified as a resistance zone, right? Previously, this zone here acted as support for the dollar index back in August and September. And then when price broke underneath it, it acted as resistance, so thus creating an overlap. So this was an overlap resistance zone. So as price came towards this resistance zone, we knew we would be heading into relatively significant barrier. In this case, price didn't even reach the zone, right? We can argue it didn't even reach the zone, but it stalled roughly, what is this, 107.16, so roughly about 150 pips underneath the zone before consolidating. You can see sideways action here again, right? It consolidated before finally breaking down and starting this downturn here. All right, so let me just tidy up the chart a little bit, and then let's quickly look at where are the key support levels for the dollar index. Okay, so once again, we see this level here, the first support at 100.82, right? Price finding support here on 3rd of September, 3rd of Feb, mid-April, and you can argue here as well in early May as well, and found support here before finally breaking under. Right, so now this is a support zone that is also where we also have the 78.6% Fibonacci retracement. Right, this retracement, we started this retracement from this swing low on 19th of July, ending it with a swing high on the 3rd of October. So as you can see, price has broken through all the other retracement levels, and this zone could be where price could offer some serious support. So and between what is this 101.20 and 100.75, this could be a potential strong support zone for the dollar index. And of course, the second support is simply this significant swing low that took place here at 100 in mid-July. And if you zoom out and go back, we can see how this is a strong overlap support zone. Right, to the upside, we've done a Fibonacci retracement as well, starting from the swing high here on the 3rd of October, going down to the swing low last week, on Friday. We can see that there's an overlap level here as well at 102.62. Right, price bouncing off this level here on, let me just zoom in now. Right, price bouncing off this level here on 29th of July, going up to the upper trend line and then falling down again. And when it broke the support at 102.62, this support level then acted as a resistance. You can see price clearly failing to climb above this level before dropping lower. So this creates an overlap resistance level that aligns quite well or quite close to the 23.6% Fibonacci retracement. Right, higher up, we see price making this pullback or this swing high here as well, creating this pullback resistance or swing high resistance at 104.15, which also aligns quite well or quite close to where the 50% Fibonacci retracement level lies, right? So these are where the two major resistance areas levels are for dollar index. And take note, it is also trading in a bearish channel where the upper trend line of this channel could act as a major resistance point as well. And of course, first support is at 100.82, second support is at 99.77. All right, okay. Of course, we're not going to have time to go through all the currency pairs or commodities or indices. So if you have any requests or any particular instrument that you would like me to analyze, do let me know, and I'll be more than happy to go through it with you. Otherwise, I'll just look at gold, then maybe one of the other FX pairs, and then probably look at oil as well, and maybe one of the indices. All right, do let me know if there's anything in particular that you would like me to go through with you. All right, okay, here we are for gold. So as we know, gold prices and the value of the US dollar typically have an inverse relationship or a negative correlation. So what does that mean? So of course, that means if typically when the value of the US dollar is falling, typically that acts as a tailwind for coal prices, and when the value of the US dollar is rising, that typically acts as a overhead pressure for gold prices. So as you can see here from 13 December, which is where the FOMC meeting took place, markets turned dovish, or markets started to take on a very dovish expectation that the Fed is ready to cut rates aggressively next year. So that created a strong dollar sell-off, which boosted gold prices here. And it's once again coming up to a very strong resistance zone, right? So we've done the Fibonacci retracement from this swing high here on 4th of December, going down to the swing low on the 13th. You can see that this pullback resistance level here lies quite close to where the 61.8% Fibonacci retracement is. So this is the major resistance zone for goal, right? So of course, if we see the dollar continuing to slide lower, especially if inflation data continues to ease as well, we see further easing of inflation data in the US, and that's very likely going to cause the US dollar to fall, and we could potentially see gold prices break through this major resistance zone here. And of course, this swing high here, or the top of this wick here, is the absolute swing high for gold, and that's why we've identified the second resistance, which is at 2,149 basically. How will BRICS affect the USD? Okay, there's a question by Tony. How will BRICS affect the USD in the long run? They've always tried to sort of displace the US dollar in terms of trading partners with the major BRIC companies, right, among the BRIC companies. But so far, we've not seen that displacement actually take place, right? Yes, of course, the countries in the BRICS will perhaps trade more actively with their own currencies, like for example, between Brazil and China, right? They may trade in their own currencies and not use the dollar to trade their commodities. But so far, we've not seen anything that's going to have a major impact on the value of the US dollar, right? That said, doesn't mean it's not going to happen in the future, but as of now, there's been nothing, or there's no evidence to show that increased trading among BRICS countries or BRICS partners in their own currency is having a major impact on the value of the US dollar, right? Just to quickly summarize that, yeah. Right, there's BRICS has been around for for quite a few years, maybe 5, 6, 7 years, right? There have been developments along the way, but we've not seen any major material impact on the value of the US dollar due to any outcomes or agreements from this BRICS organization. Okay, right. So as of now, the dollar is still the world's reserve currency. It is where most of the prices of commodities are still listed in the US dollar and traded in the US dollar on the major exchanges, right? Okay, so right, okay, this is what we have, the resistance levels for gold. Let's look down at where the support levels are. So clearly you can see here when price broke above the bearish Ichimoku cloud, it sort of signals that, okay, maybe we are going to start to see a new bullish trend emerge, which is what we saw from November onwards. And of course, not everything moves up in a straight line. You can see that price retreated quite sharply, but then once again found support once the Fed signaled a very dovish outlook for 2024. All right, so first support is this pullback support level here at 1,977. You can see price making a very significant swing bounce here, right? Is a very what we're looking for, a significant swing low such as this, swing high such as this, another swing low such as this, and so on, right? So this is how we can identify major support and major resistance zones for any instrument. All right, okay, so first support is at 1,977. Second support is at 1,934. Why is it the case? As I mentioned, we saw the significant swing low bounce here. We also see price running into resistance here briefly for a few days before breaking higher, and also we saw price running into resistance around here as well. And this level also aligns quite close to where the 61.8% Fibonacci retracement is. This retracement started from the swing low here on 6th of October, going up to ending with the swing high here on the 4th of December, right? So you can see that not only do we have a pretty strong overlap support level here, it also aligns quite well with the 61.8% Fibonacci retracement. Okay, let's quickly look at oil, and then I'll do the currencies again, or maybe I'll do one of the indices. We'll quickly cover the indices. We can see due to weakening global demand, crude prices have been in a downtrend since October, right? We see not only demand in the US falling recently, global demand is also projected, at least global demand for crude is projected to slide low as well, which is why despite the production cuts by OPEC and OPEC Plus, we've seen crude prices slide lower since mid-October, and this recent bounce here that we see in mid-December here, this was mostly driven by the fact that we had drone attacks on commercial ships and oil tankers in the Red Sea. Now that Red Sea passage is a very critical part of shipping infrastructure, because that is one of the shipping lanes that goes through the Suez Canal, where we see a lot of shipments from Europe go through the Suez Canal into Asia and vice versa, right? So if there's going to be disruptions in that area or in that part of the world, commercial ships and oil tankers will divert two of the major big companies such as BP, which is an oil company, of course, and Maersk as well, which is a big shipping company, one of the biggest shipping companies. They have diverted their ships from this region. So when ships get diverted away from the Red Sea and they're not going to pass through the Suez Canal, they have to find an alternate shipping route, which is going to cause shipping delays. Of course, the vessels themselves will use more diesel to make that longer commute. So that is what has caused this recent spike in oil prices. Now, will that continue if the drone attacks fade, right, or they completely come to an end? That's when we could see oil prices continue to slide lower again, right? We've seen the impact. Initially, we saw how the impact of production cuts helped to boost oil prices as well, and also we had a strong summer in the US where we saw strong demand for crude over the US summer. So combination of that with production cuts led by Saudi Arabia has helped to propel crude prices. But now with demand falling not only in the US and globally as well, we can see that it's sliding lower. So if there's no perceived or there's no further escalation in the Red Sea and there's no further escalation in the Middle East with regards to the ongoing conflict, we are likely to see crude prices slide lower. Okay, so first resistance is at $75 per barrel. Second resistance for WTI is 78.50. You can see that we've done a Fibonacci retracement here from this swing high 20th of October going down to this swing low on the 13th of December. We see that this pullback resistance level here at 78.50 aligns very well with the 50% retracement. We also see a pretty decent overlap level here at $75. We see price finding support here 27 November before bouncing higher, and then it has run into resistance last week as well. Right, so this is the major resistance areas for WTI oil, and do take note the upper trend line of the bearish channel will also act as resistance, as another resistance zone as well. To the downside, we saw prices bouncing off the support here at 68.90. Right, this is a pretty decent swing bounce here, and it also aligns quite well with the 61.8% Fibonacci projection. We started this projection from 30th of November, coming down to 13th of December and ending on 20th December. Second support, of course, is this multi-swing low here that took place on 31st of May, 12th of June, and of course on 28th of June. So this is a very significant second support for WTI oil at $67 per barrel. All right, okay, with that, right, okay, we've got time for, okay, let's just cover the pound and dollar CAD, and we'll see if we have time for anything else. All right, so lo and behold, the magical date, 13th of December, the Fed projecting a very dovish outlook, sparking a huge dollar sell-off, and of course currency pairs, that's going to cause currency pairs such as the pound to rise sharply as well. But we see it running into resistance here. The first resistance is 1.2792. Right, this is a pretty strong overlap resistance level, right? You can see price finding support here on 25th of July, again on 28th of July, and when it finally broke under, you can see it ran into resistance here 8th of August and 21st of August, and of course finally running into resistance again short in mid-December, right? So this creates this sort of activity, price action creates a very significant overlap level. That is why we've identified it as the first resistance. We'll just tidy that up. Second resistance is this pullback resistance here, price running into resistance at roughly 1.2942, right, which is also where it's quite close to where the 78.6% Fibonacci retracement lies. So that's where the second resistance for the pound is, right? Do take note of this ascending trend line here. This trend line has been respected several times now. You can see it since 1st of November, 10th of November, and of course 13th November, and even you can argue last week as well, 21st November, it found support around this zone. So this is a very important ascending trend line for now, where we could see price which could continue to offer support for the pound, right? So should price retreat around to this zone again, we could expect it to bounce off this trend line and move higher towards the first resistance. Okay, we also have an intermediate support at 1.2610. Right, we see prices finding support here right at the start of December, and then once it broke under, you can see that on 8 December and ran into resistance as well, and now it's offering support again. So we've identified 1.2609 as an intermediate support. First major support is at this overlap level here, and once again you can see clears resistance here on 15th November, and when it broke above it, it found support on the 22nd, and it found support on the 8th of December and 13th as well. And this level, overlap level, aligns very well with the 38.2% Fibonacci retracement as well. So that's how we've identified the first support. Second support is once again another overlap support at 1.2379. So you can see the trend for the pound is to the upside. In fact, I think we can even draw a channel now, right? We actually have a bullish channel, right? Yep. You can even add in the channel to clearly tell us that, okay, this is a pretty strong bullish trend where price is quite likely to find support around this zone here before bouncing higher, right? This would be a pretty strong support zone for the pound. All right, okay. Next up was dollar CAD. Okay, let's look at dollar CAD. Right, so you can see, okay, was there anything on the cloud here? Yep. Similarly, right, you can see that price was trading under the bearish Ichimoku cloud. Then as price came into the cloud, remember, the bearish Ichimoku cloud can act as potential resistance zones, which is what we saw here on the 6th of November. But when price finally broke above it, that signals to us a confirmation of the reverse of this bullish reversal. You can see that prices had already bottomed here before reversing to go higher, and when it breaks through the bearish cloud, it sort of confirms the change in the bearish, confirms the bullish reversal, right? And that's why you can see the bullish channel begin to develop as well. All right, so that's pound. Again, dollar CAD. Similarly, dollar CAD was trading above the bullish Ichimoku cloud, and when it finally broke through it, it signaled the confirmation of the reversal. So this is now the strong bearish trend. We see descending trend line as well, right? Price has respected this descending trend line. Let me highlight it so it's clear for everyone, right? Over here in mid-November, here again as well, the end of November, and over here as well in mid-December as well, right? So you can see how this trend line has offered or has helped us to identify a major or a significant support or resistance area, right? Okay, we've also done a Fibonacci retracement of this retracement started from this swing high here, 1st November, ending at 22nd December. So you can see that the 23% retracement level aligns quite well with this overlap level here, right? You can see price running into resistance here. This is a significant swing here. Then when price broke above it, it found decent support before bouncing higher again. You can even argue here on 19th September, it found support once more before moving higher. So this clearly is a strong overlap level, which would acted as support for a couple of days before price finally broke under. So now this is going to act as a major resistance level for dollar CAD, and it also aligns very well with, or quite closely to, the 23.6% retracement. Okay, second resistance is at 1.3486. Once again, as you can see, price bouncing off this level here on 29th of September, and of course very clearly once here on 4th of December. And this level again aligns very closely to the 38.2% Fibonacci retracement. So these are where your retracements resistance levels are for dollar CAD. Right, I've also done a Fibonacci projection. This projection started from here, 10th of November to the second point, 4th December, ending on the 12th of December. I'm using the 100% Fibonacci projection to project where price has reached, and it has sort of reached it. You can argue that it reached this level last Friday, and has bounced off it now. So I've labeled it as an intermediate support. It may not, this level may not hold, and I would use this intermediate support level as a sort of a bearish breakout confirmation, right? If price breaks above this, then or breaks below it, sorry, we're going to see it run potentially fall towards the first support at 1.3162, which is the strong pullback support level here that took place in mid end July. And of course, second support is at 1.3108, which is a significant swing bounce here that occurred in mid-July, right? So these are the key levels for dollar CAD. All right, okay, if there's no further questions, then I'll just quickly look at the indices because we've covered commodities, we've covered a few of the currency pairs. Let's just wrap up with the indices. All right. So of course, with the Fed, equity markets had already sort of rebounded in end of October and bottom at end of October. You can see price broke out of this descending trend line as well, right? We had a descending trend line here. Price clearly breaking out of this and forming a significant bounce here, right? So this is also recognizing chart patterns such as this helps us identify potential bullish breakouts, right? And you can see the US. Okay, so the US 500 is the instrument that tracks the S&P 500 futures. So this is tracking the futures and not the index itself. So it's so you can see it bounce quite clearly, quite strongly here on end of October, and after breaking out of this descending trend line, you can see it continues to rise higher. We also have this ascending trend line where price has bounced off this level on 7 December as well as again on the 21st. So this is a pretty important ascending trend line. First resistance, of course, is going to be the all-time highs that took place in towards the end of December and at the start of January 2022 and December 21, start early Jan 22, right? This was all-time high for the US 500. So that's why we've identified the first resistance for this instrument. And of course, the second resistance is identified at 49.20, which is the 161% Fibonacci extension. So this extension is found by doing a retracement. So we use the retracement tool from 27th of July and we ended with a swing low here on the 27th of October. So that's how we got this extension tool to help us identify the second resistance. As I said, this is still the all-time high for the US 500. So that's where the first resistance is. To help us identify a potential second resistance zone, we are using the Fibonacci extension. All right, similarly for the US 100, if you zoom out here, you can see back in the end of November of 21 and December 21, this was the previous all-time high for the NASDAQ 100. This was at about 16,600. This is the previous all-time high where price has recently broken above it. It also found support here on the 20th before looks to have bounced off this level. Because it has broken through the previous all-time high, how are we going to identify our potential resistance areas? I've used the Fibonacci projection, starting from this swing low on the 27th of December. Sorry, not December. 27th December of 2022, going up to the swing high here on 20th of July of this year and ending with a swing low here on 25th October. I'm using the 61 and 78.6% projection levels to help identify potential resistance zones for the US 100 or the NASDAQ 100 futures. First support, of course, will be at 16,600. Second support is this overlap level here. You can see price running the resistance once on 18 July, 28 July, and when it broke above it, it found support on the 6th of December. So this is clearly a significant overlap support and we've used it to identify the second support here. Similarly, you can see how the Ichimoku cloud has also helped in identifying the reversal as well, right? You can see that this is also price broke out of a descending trend line here. Price moved above, crossing the Ichimoku cloud, and the Ichimoku cloud turned green. Price found support in the bullish Ichimoku cloud to trend higher. So we have few indicators here, like a bullish breakout of this bearish trend line, price trading above the Ichimoku cloud, finding support in the cloud, and continuing higher. So since March of this year, we already had a pretty strong indication that there was a very convincing bullish reversal and bullish trend for US equities and particularly the US 100 here. All right. Okay, so I've come to the end of today's webinar. I hope this has been a great session for all of you. Just before we end, I'm just going to launch a webinar, a poll. Truly appreciate if you guys can give me your feedback, and of course, wish you a belated Merry Christmas if you celebrated Christmas over the weekend, and today's Boxing Day as well. So happy Boxing Day for those who celebrate. And as we come to the year end, I wish everyone a happy new year as well, and enjoy your new year celebrations as we wrap up the final trading week of 2023. All right, cheers everyone for tuning in today, and I wish you all the best in your trading journey, and uh, even more success in 2024. All right, thank you everyone. And close. All right, all right. Thank you everyone. Take care and have a great trading week.